It's not about how much you earn, it's about how much you can prove through your deposits. If you're self-employed, your approval hinges on what your bank statements show, not what your accountant files. Guess wrong or underestimate the requirements, and you could waste months shopping for homes you'll never get approved to buy. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in working with self-employed clients. So if they get a big fat no from their bank, we get them a big fat yes. Who doesn't love a big fat yes? David had strong revenue, but inconsistent deposits. He actually worked in a cash business, and of course, he deposited all the cash revenue he makes, but many times he held on to it. There was a safe, sometimes went months without deposits. So David, in a cash surplus business where he was killing it, thought, hey, $1 million loan, we could do that. We could pay that off pretty much in cash, like probably easy as 1, 2, 3. Now, we looked at the last 12 months of David's bank statements, and it wasn't as easy as 1, 2, 3. He had to start depositing his cash, or was holding in a safe. So we actually formulated a plan where, guess what? You're actually going to have to, in a more timely fashion, deposit the revenue you were making. So it ran out over the next couple of months, and although he got denied, he saw some video about non-QM, spoke to some guy, wasn't kind of consulted with to give the plan of action on how he could actually qualify. So that's why he got declined, came to us, and we formulated an exact plan, an action plan. And after depositing his revenue more timely in the banks, took our advice, he had something against the banks, holding on to his money, whatever. He ended up depositing his funds, all his revenue, and over the next several months, it kind of counterbalanced. We did a 12-month bank statement program, and he ended up qualifying for higher than $1 million loan. Super, super simple. But I hear you saying now, hey, Andrew, it's not that simple. You don't just deposit all the money you're holding in your safe and you qualify. Look, there's a lot of guidelines around this, but over a 12-month period, even if there's a little bit of a spike with a letter of explanation or a CPA letter explanation, there's always a way. There's always a will, there's a way, right? There's always an explanation or a way to kind of explain what's going on. And typically underwriting in these type of programs, they do understand. And I hear you saying now as well, hey, Andrew, what if the deposits that this gentleman made are in his personal account, not his business account? So that's actually allowed. Guys and girls, you can deposit your revenue in a personal account and a business account. There's guidelines around it, but it's actually okay, believe it or not. It might even be expected depending on if he's a corporation, an LLC, sole proprietor, all that good stuff. And of course, hey, Andrew, but how much of the deposits do you count? Believe it or not, personal bank statements can go up to almost 100% of the deposits as usable income, where business bank statements right out of the gate, you can use 50%. You could actually use as high as 90% of the deposit's value with a letter from the accountant saying that the business only runs at a 10% expense factor, but typically 50% is what we use right out of the gate. All right, guys, let's go over an illustration of an entrepreneur, a self-employed revenue, the bank statements. If a certain amount is coming in every single month, what does that correlate to a payment? Because, business owners and entrepreneurs are so used to tax returns, write-offs, not qualifying, kind of being all negged out, right? So if we're going to turn that into a big fat yes, based on their revenue, what does it specifically and literally look like? What's a high-level overview of what do they actually qualify for, depending, of course, on their revenue stream? So we're going to look at a lot of different examples. So it's just good to note that personal bank statements versus business bank statements. So on personal, you can get credit for 100% of your deposits. Now, that is very atypical, meaning Schedule C, sole proprietor. Most people in business have a business bank account, 1, 2, 3, Corp, LLC, whatever it is, whatever the nature of your business is. But if you have a personal account, we can give you credit for up to 100%, but it's not really what we work off because it's very atypical. I would think out of every 20, 30, maybe even 40 bank statement clients, business bank account clients we have, self-employed entrepreneurs, 99% of them, typically out of 40, 39 of them have business bank statements and one has a personal. I don't even know the number. It might be 99 business bank statement, one has a personal. It's very atypical. It's cool, but it's just for, IRS purposes and taxation purposes and LLCs and corps and all that good stuff. Most people have a business bank account. So really out of the gate, we work with a 50% off of the deposits. That's what we can use for income. So income equals 50% of the deposits. There's ways to use more, but it's just very, rough numbers. 50% is the best because there's really not much more diligence or paperwork or things we have to ask for. If 50% isn't cutting it, we could always get a CPA letter that the expense factor isn't 50%, it's a little bit less, but let's work off of 50%. So if we're going to use some different illustrations for the money. Let's use, let's say an example A. We have a business owner who pulls in about $120,000 a year for revenue, which is awesome. Let's say we're going to color code this baby. Let's say, without getting markers all over my fingers, let's say business B, we have someone who's making about $250,000, right? We're leveling up a little bit for their business, okay? Let's say client C, business C, they're making about $1 million a year in revenue. And then let's say lastly, business D, client D, they're pulling in $5 million in revenue. So again, guys, this is yearly revenue. None of this talks about expenses, tax returns, nothing of the sort. So if we're going to start with our A, so if all these people own their businesses at 100%, you don't have to worry about removing anything specifically because of partners and all that. So let's work off that they're all 100% owners of the business. Person A, you have a nice, self-employed business, make about $10,000 a month. Client B or business B, of course, being a client specifically, makes a little over $20,000 a month in revenue. Client C makes a little over $80,000 in revenue. You're kind of like leveling up right here. Now you're in the 2 comma club from a revenue perspective. And of course, client D, now they're making $5 million a year just in revenue, of course. Doesn't mean profit specifically, but in revenue, of course. I'm not looking at tax returns. This is what we're going to work off, guys. All right, so if you make $120,000 a year in revenue, that's $10,000 a month in revenue. There's a 50% expense factor. So that's $5,000 a month in income. Now, assuming all these examples are going to work off of a 760 credit score and no debt. Now, many self-employed business owners have great credit typically and no debt, believe it or not, or it could be different, but this is what we're going to work off of as a whole. So that $5,000 a month of income, you're eligible for a $2,500 mortgage payment. So from a $2,500 mortgage payment, if we estimate $800 a month for taxes and insurance, that's going to bring us down to a $1,700 a month principal and interest, right? $1,700 plus $800, $2,500. So $1,700 is what's left for a mortgage. So this should be somewhere around a $250,000 mortgage. So let's say, for instance, your sale price range should be about $300,000 or higher. If you go $300,000 or higher from a sale price perspective, you put down at least 20%, it should land you around a $250,000 mortgage. Because if we use a rate of around 7% and a 7.5% APR, this should land you somewhere. Again, guys, this is for information purposes only, very rough, but just gives you a super high level overview, right? So it should land you around a $1,700 principal and interest payment, which is just the mortgage, add taxes and insurance. So somewhere around there should equate to $2,500 a month for the mortgage payment. Because again, in this example, out of the gate, $10,000 a month in revenue, half of that for income. So you have $5,000 with a 50% expense factor. That $5,000, assuming that 760 score, no debt, $2,500 max mortgage payment for all, max payment for all debt, but there is no other debt. So that's what we can use for the mortgage. Subtract typical tax and insurance based on this type of sale price. So that leaves you with a $1,700 principal and interest, so $250 loan. So that gives you an idea. If you're out of the gate making about $10,000 a month in revenue with just an out of the gate, out of the box 50% expense factor, you'd qualify for somewhere in the $300,000s for a sale price. Now, $250,000 for the year, this is going to flow down to a little over $20,000 a month. So $20,000 a month, we can use off of 760 score, no debt, business bank statements, right? Remember over here, 50%, so that's $10,000 a month in income. And then assuming all this information, this goes down now to a $5,000 max payment. So this will give you more purchasing power than this example. So if we worked off of a $750,000 sale price, if we did 20% down, like good boys and girls, putting 20% down in these programs, which is very typical. Say we use a $600,000 loan. Say again, we use a rate of 7%, 7.5% APR. Don't mind my chicken scratch, it'll all make sense. So that $5,000 payment, right? So this is about a $4,200 a month principal and interest. So you figure off this number, you're going to have about $800 a month for taxes and insurance, which is higher than this example, which should be roughly within the range, just to be very conservative. So that puts you into the $5,000 a month payment. So that $5,000 a month payment, again, if we go over this example, $20,000 obviously a month. From there, $10,000, which is half. Half of that again for the mortgage payment, because there's no debt, it's $5,000 for the max mortgage payment. You have $750 with 20% down to $600 from there. Principal and interest of $4,200 a month. Add in the tax and insurance, that's the sweet spot. So there you go. Just by going from $120 to about $250 in revenue, the max mortgage payment doubled, and the sale price range over doubled for qualifications. So now, if we look into an example of $1 million a year in revenue, so $1 million a year is about $80,000 a month, right? We can use 100% of that, amazing credit, no debt. So $40,000, half of that is $40,000, right, over there. So that $40,000 a month is the income that we give them credit for, 50% expense factor. And then from there, with no debt, believe it or not, you can qualify for a $20,000 mortgage. So what does that look like for a $20,000 mortgage? I don't really know, but let's take a look. You know, a $2.5 million home, if you put 20% down, that's a $2 million loan. So a $2 million loan, you know, 20% is $500K. Sounds like a lot. I mean, the person's making a lot of money in revenue. This is a big example of a home, but let's see if they qualify. $2.5 million home, 20% down, $2 million loan, 7% rate, 7.5% APR. So that's about a $14,000 a month principal and interest. Very loose, guys, right? But this is just a great example. Then from there, taxes and insurance, you could probably add, even if you added $4,000 a month for taxes and insurance, say it was really expensive, still $18,000 a month, which is less than that $20,000 number. So they actually qualify. So again, $1 million a year in revenue, it's $80,000 a month. At $80,000 a month, half of that's $40,000 for income with great credit, no debt. That leaves half for a mortgage, which is $20,000, which is a high mortgage, which just puts in perspective, guys, right? If you're 100% on your business and you make $1 million a year in revenue only, look what you can qualify for. $2.5 million house, 20% down, $2 million loan. It's about $14,000 just for principal and interest, another $4,000, which is an overestimate for sure, tax and insurance. $18,000 a month mortgage payments, less than $20,000, you qualify. Now, we save the favorite color and the higher amount for last. So we have, I'm sure you can't tell my favorite color is blue with the suits that I wear, right, guys? All right. So $5 million a year. Now we're leveling up, right? You have $400,000 a month in revenue, $200,000 because we had half of the credit of that, right? It's right over here, half of that, $200,000 in income. Now, if this person has no debt, they qualify for a $100,000 mortgage. Now, I would say 99.999% of the viewers watching this, $100,000 a month cash mortgage, it almost seems like a farce, right? But if we do look at an example, I don't even know. Let's say a 10 million, for argument's sake, screw it. Let's live the dream. Let's say a $20 million home, right? If this person put down, actually, you know what? Let's pump it up even higher. Let's say a $25 million home. Let's really go for it. So if this person put 20% down, which is $5 million, that's a 20, we're not really used to this one, right? A $20 million, now that might have been overshot. All right, so we'll wipe that out. That's definitely a bit much for this person because they're not making 10 times as much. But let's work off a $10 million. I was getting a little aggressive there. I was getting a little excited with this blue marker. But we can ultimately work off of a $10 million house. Instead of a $25 million, you're getting a $10 million house. So sad, too bad. All right, 20% off the top there for down payments, $2 million, right? So now you're at an $8 million mortgage. Let's again use a rate of 7% with 7.5% APR. That $8 million is about $56,000 a month for the mortgage. Now, a $10 million house, you got to assume you're over $10,000 a month for taxes and insurance. This is principal and interest. So although this sounds wild, $66,000 a month for the mortgage, right? This is less than the $100,000 allowance you're given. And again, it just shows the power of the bank statement programs. So if you're a business owner, you make $5 million a year in revenue, or you want to see what a $5 million a year in revenue business owner could qualify for, again, this is the big juicy example. $400,000 a month. This is what they're bringing in. These damn Sharpies. Think I go to the gym? $400,000 a month in revenue. Half of that is what you get credit for income. Great credit, no debt. Half of that for the mortgage. That $100,000 mortgage payment on a $10 million house, which I'm sure is pretty nice. 20% down is about $2 million, $8 million mortgage, rate of around 7%. Of course, it's just information purposes only. A $56,000 principal and interest payment, $10,000 a month in tax and insurance, $66,000 a month for a mortgage. That's right, but it's way under qualification. So what does this show you guys? It shows you if you're self-employed or you're a business owner and you're so used to either hearing you can't buy because you write off all your expenses and the profit that you show on your tax returns is low. This shows the power of a bank statement program. Say that $5 million a year revenue, owner, say they had expenses and showed from a profit perspective 0, and they pulled even a $120,000 a year W-2, which is a lot, which would be $10,000 a month. On a conventional loan, that's what they would show. But on this loan, they showed $200,000. This is actually 20 times higher the qualification just by being in this program. So if any of this is resonating with you, if you're a business owner or you're just fascinated by all this stuff, make sure you go in the description below, click the link for the self-employed overview worksheet. It's a free worksheet for you guys. It's gonna go over all this stuff that I just showed. Now, of course, this is what I do for a living. I've worked with thousands of clients like this. So to me, it's a bunch of doodling and it makes total sense in my brain. But make sure you go in the description, click the link. It's an easy guide so you have no issues kind of figuring out if this makes sense for you. So if you're using a business account and your revenue's all over the place, a ton one month, nothing for the next couple of months, you might end up not qualifying for the bank statement program and you might need to use your P&L. So make sure, guys, check out our next video, my P&L. What do I actually qualify? What do I actually have to show on my P&L to qualify for a home purchase? We're gonna go over what is a P&L, what does it look like, what is revenue, what is expense, what is profit, how do you get one of these puppies from your accountant, what do you have to discuss with them, and what it takes to qualify. Make sure you check out that video, guys. It's gonna be awesome.